This isn't a market crash. There are no alarms, no emergency meetings on TV, and no red banners scrolling across your screen. And yet, something critical is happening beneath the surface of the global financial system. Liquidity is quietly leaving. It's not disappearing overnight or collapsing in a single dramatic event. Instead, it's retreating, slowly and deliberately, from places where it once flowed freely. Most people never notice this phase. They only see the outcome. Because liquidity doesn't announce its departure. It fades. It thins. It becomes selective. And by the time the headlines arrive, the damage has already been done. To understand what is happening now, you first need to understand what liquidity actually is. Liquidity is not money. It is not cash. And it is not wealth. Liquidity is the ability to transact without friction. It's the ease with which assets can be bought or sold without causing instability. It is trust, confidence, and depth, all working together. When liquidity is abundant, markets feel calm. Prices move smoothly. Buyers and sellers meet effortlessly. Credit flows. But when liquidity begins to dry up, the system behaves very differently. Small stresses appear first. Trades take longer to clear. The gap between buying and selling prices widens. Volatility increases, even without obvious news. These are not random events. They are symptoms. And right now, those symptoms are appearing across multiple layers of the financial system at the same time. This is not unprecedented. We have seen this movie before. Before the 2008 crisis, liquidity didn't vanish overnight. It retreated quietly from the mortgage market first, then from interbank lending, and then from complex financial products that no longer had buyers. The warning signs were there. They were simply ignored. Before the market turmoil of 2020, the same pattern emerged again. Funding markets tightened, and certain key interest rates spiked. Central banks had to step in, not because markets were crashing, but because liquidity was failing. Today, the signals look familiar. But the environment is very different. Interest rates are no longer near zero. Central bank balance sheets are no longer expanding freely. Debt levels are structurally higher. And confidence is far more fragile. Liquidity thrives on stability, and stability is exactly what the system lacks right now. Over the past several months, capital has begun to move differently. Not dramatically, not emotionally, but defensively. Institutions are shortening the duration of their investments. They're reducing exposure to riskier assets. They're increasing collateral requirements. They are repricing risk across the board. These are not panic moves. They are calculated responses to changing conditions. When large institutions sense that liquidity may not be there tomorrow, they act early. They always do. Retail investors usually act last. This is why understanding liquidity matters more than understanding price. Prices can be manipulated. Liquidity cannot. You can push prices higher with leverage, incentives, and a compelling story. But you cannot force liquidity to remain where it no longer feels safe. And right now, liquidity is becoming selective. It is concentrating. It is clustering around perceived safety. And it is withdrawing from areas that depend on constant refinancing, constant leverage, and constant confidence. This process does not create an immediate collapse. It creates fragility. A system can look stable on the surface while becoming dangerously brittle underneath. This is how financial stress builds without obvious warning. Credit still exists, but only for the strongest borrowers. Markets still function, but with thinner depth. Assets still trade, but with less tolerance for surprise. This is the phase where small shocks begin to matter. A minor default, a failed government bond auction, a sudden spike in funding costs. Events that would have been absorbed easily during periods of high liquidity suddenly cause disproportionate reactions. Not because the event itself is large, but because the system no longer has a cushion. Liquidity is that cushion. And when it leaves, everything becomes sharper, faster, and more unstable. What makes the current situation particularly concerning is not a single data point. It is the convergence of multiple factors. Rates are restrictive. Government debt issuance is accelerating. Economic growth is slowing. And global coordination is weaker than it has been in decades. These conditions are not compatible with abundant liquidity. They never have been. Markets can tolerate high rates or high debt. They can tolerate slowing growth or geopolitical stress. But when all of these exist together, liquidity becomes scarce. And scarcity changes behavior. Banks lend less. Funds hedge more. Market makers step back. Volatility increases. Not explosively, but gradually. This is why many people feel that something is off in the markets right now, even if they can't articulate it. The system is still functioning, but it is no longer forgiving. And that is the most important signal of all. Because when liquidity leaves, it doesn't come back quickly. It waits for certainty. It waits for stability. It waits for policy alignment. Until then, it stays defensive. The question is not whether liquidity is leaving. That is already happening. The real question is what breaks first when it's gone. And that is where the story becomes far more serious. Thanks for watching. If you found this explanation helpful, please consider subscribing for more insights. When liquidity begins to leave a system, the first thing that changes is not price. It is behavior. Participants stop acting opportunistically and start acting defensively. Risk is no longer something to be optimized. It becomes something to be avoided. This shift is subtle, but measurable. You see it in shorter holding periods. You see it in higher margin requirements. You see it in declining market depth, even when volumes appear stable. Liquidity leaves in layers. First, it exits the most fragile corners of the system. Highly leveraged assets. Speculative credit. Instruments that depend on constant rollover. Then it moves up the chain. Corporate debt becomes more expensive to refinance. Commercial real estate transactions slow down. Private markets lose momentum as exits disappear. Public markets often mask this phase. Indexes can remain elevated. Volatility can stay compressed. But underneath, the structure is weakening. One of the clearest indicators of liquidity stress is what happens in funding markets. When funding is cheap and abundant, leverage expands naturally. When funding tightens, leverage contracts, regardless of narrative. This is why central banks monitor funding markets more closely than equity prices. Because equity prices reflect optimism. Funding markets reflect reality. In recent cycles, central banks intervened early. They injected liquidity preemptively. They stabilized markets before stress became visible. This time, their options are constrained. Inflation has changed the rules. Balance sheet expansion is no longer politically or economically neutral. Every intervention now carries visible costs. This changes expectations. Markets no longer assume automatic rescue. And when that assumption fades, liquidity becomes cautious. Another critical signal appears in the behavior of collateral. In a healthy system, collateral circulates smoothly. It is reused, rehypothecated, accepted broadly. In a stress system, collateral becomes sticky. Participants demand higher quality. Haircuts increase. Lower-tier collateral is rejected or discounted aggressively. This slows the entire machine. The velocity of money declines. Transactions require more capital to clear. Liquidity drains without any single dramatic event. This is exactly how systemic stress builds. Not through collapse, but through friction. Every additional layer of friction reduces flexibility. And reduced flexibility makes the system fragile. At this stage, correlations begin to change. Assets that once moved independently start moving together. Diversification stops working as expected. Liquidity becomes the dominant factor. This is why during liquidity events, everything sells off, even assets considered safe. It is not a valuation issue. It is a liquidity issue. When participants need cash, they sell what they can, not what they want to. This dynamic explains why gold, bonds, and equities can all fall simultaneously during periods of stress. Liquidity does not discriminate. It withdraws broadly. The next phase is where consequences become unavoidable. As liquidity retreats, refinancing risk rises. Debt that was issued under assumptions of perpetual access suddenly faces reality. Rates are higher. Terms are stricter. Buyers are fewer. This is where defaults begin, not because businesses are unviable, but because financing conditions have changed. This distinction matters. A liquidity-driven default wave is different from a demand-driven recession. It spreads faster. It transmits through balance sheets. And it undermines confidence at the core of the system. Confidence is the true currency of liquidity. Once confidence erodes, liquidity does not return easily. This is why policymakers fear this phase more than outright crashes. Crashes are visible. They force action. Liquidity droughts are quieter. They persist. They drain strength over time. History shows that systems rarely fail when everyone is watching. They fail when attention moves elsewhere. Right now, attention is divided. Markets are distracted by short-term narratives. Optimism cycles through headlines. Data is interpreted selectively. But liquidity does not respond to narratives. It responds to conditions. And the conditions are tightening. The most dangerous moment in any cycle is when surface calm coexists with structural stress. This is when participants assume stability. This is when leverage rebuilds in the wrong places. This is when small shocks create outsized reactions. We are approaching that zone. Not because of one event, but because of accumulation. Higher rates, heavier debt, slower growth, geopolitical fragmentation. Each factor alone is manageable. Together, they strain liquidity. The system can operate under stress for longer than most expect, but it cannot operate without liquidity indefinitely. Eventually, something forces repricing. It could be a failed auction, a sudden funding spike, a geopolitical disruption, or simply exhaustion. When that moment arrives, the response will look sudden, but it will not be unexpected. The groundwork is being laid now. This is why monitoring liquidity matters more than predicting crashes. Crashes are outcomes. Liquidity is cause. Those who understand this distinction do not wait for confirmation. They position early. They reduce fragility. They prioritize resilience over returns. This does not mean abandoning markets. It means respecting cycles. Liquidity cycles are slower, deeper, and more powerful than price cycles. Ignoring them is costly. Understanding them is protective. We are not at the end of the process, but we are no longer at the beginning either. Liquidity has already begun to choose where it stays and where it does not. The next phase will reveal the consequences of that choice. And when it does, it will not ask for permission. It never does.